Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at APP, or Applovin Corporation. APP provides the technology platform that enables developers to market, monetize, analyze, and publish their apps. Here's the barchart.com technical opinion rating for app. The bar chart rating is a 100% buy, with a strengthening short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that APP is well above the moving average line, so the monthly trend in APP is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started late last year, so the daily trend in app is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. The app stock price is below the upper Keltner channel line, so app is inside the buy zone. Since the trend is up, we want to buy a call. App has plenty of option chains to choose from. We're going to use the May 17 option chain. Right now, the May 17 options have 34 days to expiration. Here's a good chunk of the app option chain for May 17. App closed at 75.57 on Friday. That means any calls on the list from 42.5 to 75 are in the money. Let's take a look at the profit potential for purchasing the app May 17 75 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 75 call is 7 even to 720. We tried to enter at the midpoint, so we'll use 710 as the buy price. Our call option calculator shows the profit potential for this call based on app price changes at option expiration from flat to a 12.5% increase in price. We can see that if the app stock price is flat at 75.57 at option expiration, the 75 call will lose 92% of its value. We want that to be break even or better, so the 75 call does not meet our requirements. Let's see, where are we now? Okay, now we're going to talk about the 1% rule. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now we want to review. Let's take a look at the 65 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 65 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the APP stock price is up 1% when the option expires, the 65 call will lose 13.9% or $182. We want that to be break even or better, so the 65 call does not meet our requirements. Let's see if the 52.5 call will work. The bid-ask spread for the 52.5 call is 22.40 to 23.90. We tried to enter at the midpoint, so we'll use 23.15 as the buy price. Our call option calculator shows that the 52.5 call works. If the APP stop price is up 1% at expiration, the 52.5 call will make a 2.9% or $68 profit. That's better than break even. So the 52.5 call is the one we'll buy. The call option purchase calculator also shows that if the APP stock price increases by 2.5%, the 52.5 call will make a 7.8% or $181 profit. If the app stock price increases by 5%, the 52.5 call will make a 16% or $370 profit. If the app stock price increases by 7.5%, the 52.5 call will make a 24.1% or $559 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the 52.5 stock price does not make the expected move up and remains flat at expiration, the 52.5 call would only lose minus 0.3% or minus $8, almost nothing, compared to the minus 92% or minus $577 loss for the 52.5 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the app May 17 expiration 65 strike call and sell to open the app May 17 expiration 70 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 65 call for $13.15 and sell the 70 call for $9.85. $13.15 minus $19.85 equals $3.30. So the entry price or debit cost for the spread is $330. The call option spread analysis calculator picture shows that the spread will make a 51.5% or $170 profit if the APP stock price declines by 5%, remains flat, or increases in price when the options expire. If app is down 7.5% at expiration, the trade will make 48.6% or $160. Creating the debit spread will allow us to collect a $985 cash credit to our brokerage account for the sale of the 70 call. As we said on the previous slide, this reduces the cost of entering the spread to $330. Here's a note regarding earnings reports. The next APP earnings report is scheduled for May 8. Let's review the trades one more time. The first trade was a call purchase, set to buy to open the app May 17 expiration 52.5 strike call for $23.15. We also reviewed a spread. Spread said to buy to open the app May 17 expiration 65 strike call and sell to open the app May 17 expiration 70 strike call at a debit of $330. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.